Okay, guess you guys can hear me. First of all, thanks a lot to the organizer for putting this amazing event together and for including our paper. I've been told that I shouldn't move outside of this square, which for me as an Italian who moves a lot is going to be very difficult, so let's see if I can do that. Okay, so this paper is joint work with Enrico from Tufts and Romain from UCLA. And let me get started with the motivation. So this paper starts from the premise that international portfolios and rates of return to capital across countries are harder to reconcile with frictionless capital markets. There's a bunch of stylized facts that suggest that international capital markets are segmented. So for example, there's a high degree of home bias in international investment. That is very well known. Also, international investment seems to obey a gravity equation not very much unlike the one that we see in international trade flows. And traditionally, this has been explained with information frictions. There's also extremely large and persistent differences in the capital stock per employee across countries that seem difficult to justify with differences in technology. And also, there are large and persistent differences in the marginal product of capital across countries. This is known as the Lucas puzzle. In a famous 1990 paper, Lucas measured this difference in MPK across countries and asked, why don't we see much larger capital flows from rich countries where MPK is low to poor countries where MPK is high? So in this paper, basically, we want to take a bird's eye view of this entire literature. Basically, we're trying broadly to understand the spatial allocation of capital across countries with a particular emphasis on the role of international investment frictions. And when we look at the current literature in international macrofinance on these topics, we basically find mostly stylized model. Two-country, small open economy. We also see a bunch of empirical studies that try and correlate international investment positions with a bunch of explanatory variables. What we don't have in international macrofinance literature is a workhorse spatial structural model, like the gravity models in international trade. And so that's exactly what we strive to contribute in this paper. In this paper, we propose a spatial theory of international investment and production that endogenously generates the entire network of country-to-country investment. And it also generates country heterogeneity in rates of return. So here's a brief outline of how this talk is going to proceed. I'm going to start from the theory. I'm going to present this. It's a new multi-country G model of international investment and production. The model is going to feature frictions that cause segmentation in international capital markets. The model is going to yield closed-form solutions for international portfolios that follow a logit structure. And also, it's going to deliver closed-form solutions for the steady-state bilateral asset position between countries. Okay, so that's the theory. Going into the empirics, I'm going to go to the data and try to measure a number of frictions that affect international investment that we think are important. We choose a parsimonious set. We focus on international taxes, political risk, and geocultural distance between countries. We're going to measure all these frictions. And then I'm going to show you when we put these frictions into the model is going to be able to match closely a lot of the previously mentioned stylized facts. Okay? The model is going to hopefully do a good job of describing the data. Once we've shown that, we're going to go and do some counterfactual. I'm going to show you that these barriers to international investment have a very important implication for both real efficiency, that is world GDP, as well as cross-country inequality. Okay, so let's get started on the theory side. So in particular with the production block of the model, there's going to be n different countries, and I'm going to use the following notation. I'm going to denote the country that receives the capital, where production is used with the subscript I, and I'm going to denote with the subscript J the origin country. This is where the investors are located. Time is discrete and indexed by T. Now, each country is going to have a representative firm that produces homogeneous tradable good that can be either consumed or reinvested as capital for production in the next period. The assumption of no frictions in goods trade, we can relax, okay? The capital stock of the destination country is going to be denoted by KIT, again, T is time. Capital can be invested across borders, okay? Depreciated as a stochastic rate with mean delta. In addition, each country is going to have a fixed endowment of labor, which we denote by L, and natural resources, which we denote by X. These two factors instead are immobile, so you cannot move them from country to country. Each country uses a Cobb-Douglas production technology with 3 inputs. So YT is going to be the GDP of the destination country. K, L, and X are going to be the 3 inputs: capital, labor, and natural resources. Why do we put natural resources? Because it's been shown that this is very important to have in this model. It's like a fixed factor of production that doesn't move. The 3 Greek letters here represent the output-to-input elasticities. Omega is going to be the expected total factor productivity of the destination country, and ZIT is going to be a log normal productivity shock. Factor prices are going to be determined in competitive input markets, so MIT is going to be the rental rate of natural resources, and WIT is going to be the wage rate. For capital, we distinguish 2 different notions of the rate of return on capital. One is MPK, the marginal product of capital, which is simply the output capital ratio times the output capital elasticity. And then we denote with RIJT the income that is earned by an investor from country J that invests 1 unit of capital in destination country I at time t. What does it depend on? It depends, of course, on the MPK of the destination country, so it's an endogenous object. Now, MPK is also the income earned locally by 1 unit of capital, and it's taxed at a rate tau ij. Why is there a j subscript in the tax rate? Because taxation can be discriminatory on the basis of the origin country, okay? In addition, the investors get undepreciated capital, 1 minus delta, and they are affected by this productivity shock, zeta, okay? Now, let's talk about the household side of the model. So in each period H, in each country J, there's going to be a cohort of households that is born. We're going to denote them by J, the origin country, and H, the year in which they are born. There's going to be a life cycle. So in the first period when they're alive, these agents, they're endowed with LJ units of labor and MJ units of natural resources, which they supply inelastically. They're also going to receive transfers from the government, which include the rebating of the tax rates. Now, in the second period, they transition to being from worker, they become capitalists, so they keep on living period after period off of the income that they saved from the previous year, in which they save in the form of capital, and each period a fraction of them dies at a regular rate. Okay, so this is going to be their intertemporal utility function. So I want to focus first on this term, CJHT. This is going to be the consumption of cohort H in origin country J at time t, okay? And so this utility is recursive, and it's log in consumption. There's going to be a discount rate, which is origin country specific, which is theta j. What the agents do, they choose their path of future consumption and saving, subject to maximize this utility, subject to a budget constraint. And so what's the budget constraint? For each cohort, we need that the consumption plus saving has to be equal to total income. So for the first period of their life, when these agents are workers, so when T each equal to H, their income is going to be given by labor income plus natural resource income plus tax rebates. From the second period onwards, so when T is larger than H, it's going to be capital income. So it's basically whatever they saved in the previous period. So SJHT is the saving of the cohort H in country of origin J at time T. And that gets multiplied by the rate of return which they earned on their saved capital, okay? Now, what this setup, this life cycle setup buys us, it's something very convenient. It's basically what makes our model tractable, which is the separability of the saving and portfolio allocation problems. And so in particular, all of the agents from country J are going to save a fixed proportion of their income, which is equal to the discount rate theta j. Okay, so let's talk about the international asset allocation. So in the baseline model, we're going to assume that investment is intermediated by some financier that is specific to the origin country that allocates investment across the destination country using a logit function. Don't worry, we can microfound this. In the next slide, I'm going to talk about that. But let me first just give you the equation for the international portfolio shares. So pi ijt is the share of J wealth, the wealth of origin country J, that is invested in the destination country I at time t. It depends on a bunch of stuff. Let me break it down for you. The first object is this calligraphic, this nice R. This is the risk-adjusted rate of return on capital. It's basically just the expectation of the little r that you saw in the previous slides divided by some risk adjustment that depends on the variance structure of the productivity shocks. Then there is a term here, which is the capital stock of the destination country. Basically, this is size effect. You want to invest more in larger countries. This is an empirical regularity in international investment. The third object here is going to be this delta ij. What is delta ij? This is what we call the portfolio wedges. This is all the other stuff other than proper taxation that distorts the portfolio allocation decision of the investors. So basically reflects the impediment from from investing from country J to country I. Okay. Now, let's talk about the microfoundation. Oh, one more thing. So here we have this elasticity, eta, which is the elasticity of the portfolio shares with respect to the risk-adjusted rate of return. Okay, so about the microfoundation. So we have a long appendix where we show that we can actually combine the households with these intermediaries. You can do that with different sets of assumptions. Now, importantly, each different microfoundation is going to give you a different interpretation for those for what these delta wedges are, the portfolio wedges. So in particular, we have one microfoundation which is based on rational inattention, where basically investors have to learn about the risk-return properties of the asset in each destination countries, where this delta ij may reflect informational advantage. So basically, you're born with more information about a specific country. Say, Italian investors might know more about French assets than, say, Brazilian assets, okay? Then we have a microfoundation based on extreme value distributed cost shocks. Under this microfoundation, these wedges can be interpreted as a systematic asset trade cost between countries. Finally, we also discussed to what extent the microfoundation of Koji and Yogo, this is their famous asset demand paper, can be applied to our system, although in this case it requires some pretty strong assumptions, okay? Okay, so now let me show you the following equation. This equation basically shows the clearing of the market for international capital. So it tells you that the capital stock of the destination country, the vector of capital stock, KT, has to be equal to the matrix of the portfolio shares, pi, at any given point in time, times the previous period vector of origin country wealth invested, okay? That is ST minus I. Now, what does it mean to solve the model, okay? Notice we can rewrite, we show how to do that in the paper, the matrix of portfolio wedges in terms of the vector of capital stocks, and so also the vector of wealth, okay? And so basically, finding the steady state equilibrium of the model means to find the fixed point such that basically the capital stock of this period is equal to the capital stock of the previous period equal to some K star, okay? Basically, the fixed point of this system of equation after removing the time subscript, okay? And then what we can do, we remove the time subscript and we can obtain, this is the equation for the bilateral steady state asset position, is the wealth from J that is invested in destination country I, we call that AIJ, and it basically resembles a lot the gravity equation in trade. So it's proportional to the capital stock of the destination country, KI, the wealth of the origin country SJ, and it's inversely proportional to the portfolio wedge delta IJ, which in our case replaces the distance that we have in international trade, okay? Okay, so that's the model. Let me tell you next, how do we take this model to the data? We need a bunch of data. So most of the macroeconomic data that we input in the model comes from the Penworth table. So from the Penworth tables, we get output, which is PPP GDP. We get the labor share, an estimate of the savings rate. We also get capital stocks, okay? Although we don't input them in the model, because the model, remember, endogenously generates the entire network of country-to-country investment. It also generates endogenously the capital stocks. And so the capital stocks from the Pennyworth table, we're going to use them only for validation. Then from the World Bank, we get an estimate of the income share of natural resources. That's going to be Xi in our model. And then starts the task of getting estimates of the various frictions. And so the first one is international taxation. We basically did a lot of work here to collect data on international taxation from all sorts of sources. Long story short, we end up with an estimate that we call tau ij0 of the statutory bilateral tax rate on capital. What goes into this estimate? Basically, corporate income taxes, dividend withholding taxes, and interest withholding taxes. Mind you, these estimates, tau ij0, are adjusted for tax treaties, okay? So basically, in computing this, we take into account whether there is a tax treaty between I and J that reduces the withholding tax rate on interest and dividends. But there is an additional problem. And as you know, firms use tax haven to avoid withholding taxes. And so what we do is we have a simple model addendum that we basically combine with a regression that uses capital flows to tax havens. Rate, tau ij0, into an estimate of the effective tax rates that take into account the routing through tax haven. And basically, this is the tau ij that we actually put into the model. Okay, so we try and be as careful as possible with the measurement of applicable tax rates. Okay, so that's taxes. What about the portfolio wedges? So we assume that we, okay, I made a mistake. I clicked what I shouldn't have clicked. Thank you. Okay, so we assume that we can decompose the portfolio wedges, delta ij, into two sub-wedges. One corresponds to geopolitical distance between countries, and the other captures political risk, okay? Of course, we can't measure wedges directly, but what we can do, we observe some variables in the data that we think are good proxies for these wedges. And so we have a measure of political risk that comes from the International Country Risk Group. And then another thing that we did in this paper was to undertake a major data work to construct what we think is the most comprehensive database so far of measures of geographic, linguistic, cultural distance between countries. And so what we're going to assume is that these wedges, delta PR, delta dist, are log linear in these observables, okay? So there's going to be some semi-elasticities beta between these observables and the wedges that we are trying to measure, okay? And so we have to estimate these semi-elasticities. Now, what we can do actually is we can take the previous equation for the bilateral positions, we take logs, and what we get is basically a regression equation that has the log bilateral asset position on the left-hand side, and on the right-hand side, all of these observables, okay? Plus, there are country of origin fixed effect and country of destination fixed effect, okay? And so, long story, to estimate these semi-elasticities, what we need to do is we run this gravity regression, we recover the betas, we input them in this equation, and we end up with the wedges that we actually input in the model, okay? So that's our empirical strategy. The nice thing about having this regression design is that we can control for a lot of stuff, basically. We can put a lot of control in this regression. And in addition, notice that even if you don't think that we're measuring risk properly, at the destination country level, we have destination country fixed effect that capture difference in fundamental risk across countries. So we have a very rich set of controls in this regression. Okay, and so all of this data is available through a new website that we've created, the Geopolitical Distance Repository. So feel free to visit that. And so what do we put on the left-hand side? We need measures of the bilateral asset position. This one we use data that is originally from the IMF on international portfolio and direct investment, equity and debt. And this data that has been restated by a bunch of colleagues from a residency to a nationality basis to account for investment routing through tax havens. And so Matteo Maggiori, Jesse Strager, and their co-authors have done some amazing work on adjusting the IMF portfolio investment data. And then this other paper has done a similar work for foreign direct investment data. So that's basically what we put on the left-hand side of this regression. I don't have time to show you all the regression, but trust me, everything is nice and significant. Let me instead show you what happens when you take the elasticity assay, you compute the wedges, and you plug them into the model, and you solve for the equilibrium. This picture basically shows you the model-implied network of country-to-country investment. Here, the thickness of the lines represent the size of the bilateral asset position. And notice that we have basically, we did a lot of data collection, so that means that we have 95 countries in our model. That's more than the typical trade. I should talk about how well the model fits the data. Here, I need to make a clarification. So I don't want to just show you the model fit, because remember, our point is to show that frictions are important. Perfect. And so what I want to show you is that the model is able to match the data thanks to the frictions and not to some other feature in the model. So I want to compare the model with the frictions to a benchmark model where the frictions don't matter. So what you're seeing here is the correlation between the model-implied external portfolio shares for the frictionless model, those are from on the horizontal axis, against the actual data, okay? So again, in this model, there are no frictions. So the model without friction, okay, generates external portfolio shares that are broadly correlated with the actual ones, but as you can see, it's not an amazingly good relationship. When we put the frictions in the model, boom, the fit of the model improves quite dramatically. Now, you might say, look, you targeted this correlation because you run this regression. In partly what this regression does is to find the betas that maximize the fit of this relationship, and so that's absolutely true. So we think of this as a targeted moment of the model. And so the next question is, how well does the model do in matching stuff that it hasn't seen? And so what stuff did the model not see? Rates of return to capital, so specifically MPK, and home bias, okay? So we look for both of these variables. So these are the untargeted moments. We look at both the mean, the standard deviation, but also the correlation, the cross-sectional correlation between our model data and the actual data. So unlike the typical macro model, here we want to be more like a trade model. We want to be able to not only match the mean and the dispersion of these variables, but we also want to be able to predict MPK and home bias for each individual country, okay? So there are 3 columns in this table. The first one tells you the moments for the actual data. Columns 2 and 3 is the model in 2 different flavors. This is the baseline model with all the frictions, and this is the frictionless model. Okay, so the frictionless model, as you can see, doesn't generate any home bias. This is not a surprise. The frictionless model is very much like a CAPM-like world, where all countries invest in symmetric portfolios. So there is some dispersion in rates of return to capital in the frictionless model. Where does it come from? It comes only from fundamental risk, because again, there's no frictions in this model. So it does capture some of the variation in MPK across countries. The correlation is not too bad, but again, we're far from explaining everything. But again, when we put the frictions in the model, the fit of both of these moments improves very significantly. We match almost perfectly the standard deviation of MPK, and also the correlation jumps up to 0.66. So now we explain actually most of the correlation. With home bias, basically, we have a perfect match not only of the mean and the standard deviation, but of the home bias in each destination country. This is very important. So this is a scatter plot of the relationship between the model home bias and the data. And why is this important? Because remember, the regression only had external investment. The regression didn't see any data about domestic investment. So this is completely out of sample. Okay, so that's the fit of home bias. Now, the model also does a good job of reproducing some well-known stylized factors. So this is the relationship between MPK and log GDP per employee. So long story short, as observed by Lucas, poor countries have much higher MPK, and so our model is able to reproduce this relationship well. Another less well-known fact that has been pointed out in a paper by Allocation and Zhang, I think in the RFS, is that MPK correlates positively with home bias, okay? And so our model is also able to replicate this other stylized fact, okay? Okay, so now hopefully I convince you that the model does a decent job explaining the data. And so what I want to do next is, how much time do I have?
A little over 5 minutes.
Okay, perfect. So I want to, with the time got left, I want to discuss a little bit how we play with our model. We do counterfactual exercises. The first and most obvious counterfactual you want to run is you want to find out what happens when you introduce these wedges from a laissez-faire benchmark. So you start in a world with no frictions, you introduce the wedges, how much world GDP do you lose? So international taxation reduces world GDP alone by 2.6%, okay? What about political risk? Political risk costs about 40 basis points of world GDP, and geopolitical distance between countries, that's the delta dist wedge, costs about 5.2% of world GDP. And when you put all of the frictions in the model, so that's the equilibrium that we assume we observe in the data, all of the frictions together are worth almost 7% for real efficiency. Now, I also promised that the model will say something about cross-country inequality, and so I'm going to show you this graph. What this graph shows you is the cross-sectional distribution of the capital stock per employee across countries. The light blue area represents the model that we see in the data that has all of these frictions, okay? The dotted red line represents the counterfactual where we remove all of these frictions. And what you can see is that when we remove these frictions to international investment, capital reallocates itself much more uniformly across countries. Basically, half of all of the dispersion in capital stock per employee goes away. And because capital feeds into GDP, also GDP per employee differences across countries are reduced. So this is the same graph with GDP per employee. And basically there, almost a quarter of the cross-country differences in income per employee go away. Okay, so important implications for inequality as well. The last thing I wanted to show you is what happens to net flows, to net international investment positions. So in these three panels, you have on the horizontal axis log GDP per employee, and on the vertical axis, you have the international investment position of each country as a percentage of GDP. So this is basically the Lucas observation. Look, so let me explain first the panel. The first panel is the actual data. The second panel is our baseline model with all of the frictions in place. And so this is basically matches Lucas' observation. Look, we would expect, given this big MPK differences between countries, we would expect rich countries to be net providers of capital, so to be net savers. And instead, there is basically no relationship between the net international investment position and the GDP per employee, both in the data and in our model, which behaves very similarly. What happens when you remove all of these frictions? Boom, all of a sudden you have a very strong positive relationship between the level of income and the net international investment position. Basically, rich countries become net providers of capital to poor countries, okay? So we do a bunch of robustness exercise, perfect. In the model, where, for example, we check the different years. We use different cuts of the data to run the same regression. We break down between FDI, FPI. We also use unrestated data. We use different estimators. We have, on top of OLS, we have the pseudo-Poisson regression, which allows you to include the zero flows on the left-hand side. We also have an IV specification in the appendix. And we also extended the model, okay, to introduce additional frictions. So for example, we can introduce frictions in good trade. We can introduce capital controls. We can introduce other stuff like currency hedging costs. So the model is very easy to extend in a number of directions. And that's basically what we hope people will do. We will take this model and they will use their own frictions. Okay, so I'm pretty much out of time, so let me conclude. So what we did today was to see a new quantitative spatial model of international capital allocation. We measured taxes and geopolitical frictions to cross-country investment. And then we show that with this small set of frictions, the model can explain a lot of the important stylized fact about the structure of international portfolios and rates of return to capital. And then we showed that the frictions basically have big implications for both efficiency, so they cost nearly 7% of world GDP, and they account for almost nearly half of the cross-country inequality in capital. Okay, so that's all I have. Thanks a lot, and I look forward to Adrian's discussion.